My YouTube channel. My name is Tabitha, and today we are going to talk about dollar cost average. So dollar cost average is a strategy that is used by investors to make capital gain or make profit in the financial market or even with investing with the bank. So dollar cost average is the topic of today. So let's see how we are going to handle that. If you're new to this channel, subscribe for more videos. So the agendas of today are going to be the definition of the dollar cost average. What does it mean and why do we always use it? Another agenda is going to be advantages of using the dollar cost average. And then I'm going to show you the table illustration and the graph illustration and how you're going to take the profit. How does it really work, the conclusion. And then if you're an investor, you can now go and try it and see what we are going to talk about today. So everything we always learn by doing. So if you learn today and you go and try it and see how it works, and then you will appreciate this video and watch more of the videos. So I've already tried this kind of strategy and I know it works. So now let's see what is the dollar cost average. So the dollar cost average is the practice of investing a fixed dollar amount on a regular basis, regardless of the share price. It doesn't matter whether the price goes down or up, you still invest that fixed amount of the dollar. So it depends on how much you want to be investing on the regular basis. It could be 500, it could be 1,000. So that is the definition of the dollar cost average, is the practice of investing a fixed dollar amount on a regular basis, regardless of the share price. What are then the advantages? Why do you use dollar cost average? So this is the people who are investing in stock, mutual funds, and a lot of the other stuff. So the advantages is like it's another way of you to develop discipline. So if you do it on a regular basis, it's going to be part of your life and you will keep doing it, which is profitable in the long term. So investing habit become more efficient because the more you do it, the more you get to know and understand, and also having trust in some companies because you have been doing it over time and things seem to be the same. So it could be also build the potential of a lower your risks of stress and also the risks over time. So instead of buying on higher prices, you can also buy on a lower prices, and as time goes by, as we take the intervals, so the risk of losing money reduce. So instead you end up making profit because the price had been fluctuating and you are taking advantage of that by investing the fixed amount of dollar every month. Or if you have the quarterly one, you can also do that. If you do the bi-weekly one, you also do the bi-weekly one, depending on your situation. So those are the advantages of using the dollar cost average. So now let's look at how it works basically is like, as the price of the stock rise, fewer units are bought. So at this point, you will buy fewer units of the shares. And as the stock price fall, more units are bought. This is when you have experience in the stock market and you have been investing in the companies and you have trust over these companies, the long life of these companies. And then when the price fall, you never panic. So instead, you look at it as an opportunity and you will buy more of the units. So, and over time, as the price fall, you buy more unit. As it goes up, you also buy more. It has like that. And then that always eliminate the risk of losing money. Instead, you make the profit. So that's how it works. When the price goes up, you buy fewer units. When the price goes down, you buy more units. So if it's something fixed, you want to do purely dollar cost average, and then you buy regardless whether the price is up or is down. So now let me show you the table illustration. First of all, you pick the periods that you want to be using. Some people, they can use monthly, others use bi-weekly. So my periods that I'm trying to use is like the P1, P2, P3, P4 that represent month. Okay, a month. So a month one, the market price was $40 and you invest $1,000. That is fixed amount. So the shares that you purchased were only 25 and the share you own is 25. They are 25. In the period number 2, the price dropped to 20, which means it reduced by 50%. So the price now is $20. And for people who have no experience in investing, this can make them panic because the price goes way down. So they will end up like selling and they lose money. But people who have experience and you trust the company that you have invested in, and then it doesn't make you panic. Instead, it becomes an opportunity of you to buy more shares. So you go ahead and invest your 1,000 again, and you get 50 shares. So when you add the two up, which is 25 plus 50, the total number of shares that you get is 75 shares. So, and then the month of number 3, the price goes up to 40. So at this time, it could be an opportunity for you to sell your 70 shares, but you want to still keep it and invest more. So you go ahead and invest your 1,000 and you get your 25 shares, which bring your numbers of shares to $100. So you add it as you go down. So that one give you the total of 100 shares. So, and then next month, you see that the price goes to 50. At this point, you see the price has really actually increased to $50 and you still have your 1,000. So you invest your 1,000 and you get the 20 shares and you have 120. By the end of that month, if the price continue to be like $50, and you want to sell your shares, and then we can now see if you're going to make the profit or a loss. So you can make the calculation and see if you're going to make a profit. If you're going to make the profit, and then you might consider selling, because most of the time you can see if it's a gain or a loss, right? But for like a dollar cost average, sometimes you don't really, it could be showing negative, but when you do all the calculation, it could be that you have made a profit of 2,000 or 1,000 or something like that. So you can make your calculation and see if you're making the profit and if you can sell instead. So that is the table illustration of the dollar cost average. You have your periods of time that you pick, the market price, the amount invested, the share purchased, and the total number of shares that you owned as you go down. So now let's look at this. So what is the total cost? Like if you invest for 4 months, 1,000 each month, how much are you going to incur? 4,000, right? So in this case, let's assume like we are not paying any commission to buy these shares. We are investing in ETFs when you are investing with Questrade, right? So you don't need to pay any commission at all. So your cost is, so your cost is 4,000, and the current value will be the market price now, which is $50, and the total number of shares, which is 120. So if you multiply, let's decide we are selling and we are closing these positions that we have been investing in. So when we're closing, we take the total number of shares times the value of the price, the market value of the price of the shares now. So that will give you 6,000 gain if you sell, right? If you sell your stuff, you take the current value minus the total cost. So the current value is 6,000 minus 4,000, which give you 2,000. This is on the assumption that we did not incur any commission. And for example, if you are investing with Questrade and you incur like a $5 commission per transaction, so it will be like $5 times 4, right? So if you do $5 times 4, let's say you're always investing in one stocks, right? So $5 times 4, that would be $20. So you can subtract it from this 2,000 and you still make the profit. So over the long term, the dollar cost average will make you profit even in when the price is up and down, when the price is going down, when the price is going up, and over time you might make profit. So it depends. So if you want to go and try and see how it works, you can watch this video, show it to your friend, and give it a like, give it some thumb up, give your opinion about how I present it. And if you have something to add, you can also add it too. And so like this is the graph that shows how the dollar cost average look like under the graph. So the $1,000 is showing the fixed amount that you were investing over the 4 month that you were investing. And if you look here, you can see like the green one is representing the share price, and the yellow one is representing the number of the shares you purchase. So when you look at here, the share price is 40. So when the share price is 40, you're only buying 25 shares. So, but when the price goes down to 20, you're only buying 50. You're buying more shares, which is 50 of the shares that you're buying. So when the price goes back to 40, it comes down again. The number of shares goes down and it's 20 shares. And when the price goes to 50, the number of shares actually go down completely, which is 20. So if you now add this line, the prices of this, the prices are there, and then this is the number of shares, you can add them up and you get the total number of the shares that you bought over that period of time that you had been investing, the fixed dollar of 1,000 every month. So that is the illustration, the graph illustration. And if you like the video, please consider subscribing, and see you next time for more wonderful videos like this. Subscribe for more videos. Thank you.